Netflix, NFLX, has been struggling lately and is down 37% in the last 3 months. The following option plays give different ways to play the stock depending on an investor's risk/reward preferences and directional outlook. The technical opinion rating is an 88% sell with a weakening short-term outlook on maintaining the current direction. Rather than just buying the stock, investors can use the options market to find smart ways to trade Netflix stock with an attractive risk-to-reward ratio. Implied volatility is high at around 47%. The 12-month low for implied volatility is 21% and the 12-month high is 53.81%. The 4th percentile is 94%. That means it could be a great time to be a seller of options on NFLX. Option trade idea 1, bull put spread. A bull put spread is a defined risk option strategy that profits if the stock closes above the short strike at expiry. To execute a bull put spread, an investor would sell an out-of-the-money put and then but a further out-of-the-money put. This bull put spread trade involves selling the April expiry 375 strike put and buying the 365 strike put. Selling this spread results in a credit of around $2.75 or $275 per contract. That is also the maximum possible gain on the trade. The maximum potential loss can be calculated by taking the spread width, less the premium received and multiplying by 100. That give us 10 to 2.75 x 100 equals $725. If we take the maximum gain divided by the maximum loss, we see the trade has a return potential of 37.93%. The probability of the trade being successful is 61.6%, although this is just an estimate. The spread will achieve the maximum profit if NFLX closes above 375 on April 14, in which case the entire spread would expire worthless, allowing the premium seller to keep the $275 option premium. The maximum loss will occur if NFLX closes below 365 on April 14, which would see the premium seller lose $725 on the trade. The break-even point for the bull put spread is 372.25, which is calculated as 375 less the $2.75 option premium per contract. Option trade idea 2, short iron condor. The next strategy we will look at is a short iron condor. An iron condor aims to profit from a drop in implied volatility, with the stock staying within an expected range. When implied volatility is high, the wider the expected range becomes. The maximum profit for an iron condor is limited to the premium received, while the maximum potential loss is also capped. To calculate the maximum loss, take the difference in the strike prices of the long and short options, and subtract the premium received. Traders could sell the 365 strike put and buy the 330 strike put. Then on the calls, sell the 400 call and buy the 435 call. Yesterday, that condor was trading around $10.94, which means the trader would receive $1,094 into their account. The maximum risk is $2,406 for a total profit potential of 45.47%. The profit zone ranges between 354.06 and 410.94. This can be calculated by taking the short strikes and adding or subtracting the premium received. Let's take a look at another potential option strategy. Option trade idea 3, bear call spread. If a trading thinks that NFLX stock will decline, or at least not rally by much, they could look at a bear call spread. The trade would involve selling the 375 call and buying the 385 call. That spread could be sold for around $4.80, which means the trader would receive $480 into their account. The maximum risk is $520 for a total profit potential of 92.31% with a probability of 46.6%. The break-even price is $379.80. This can be calculated by taking the short call strike and adding the premium received. As the spread is $10 wide, the maximum risk in the trade is 10 to 4.80 x 100 equals $520. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. For a bull put spread, setting a stop loss of 25% of maximum risk is a good idea. In the case of the NFLX example above, that would be a loss of around $180. For the iron Condor, a stop loss of 20% or around $480 would be a good idea, and for the bear call spread, a stop loss around $130 makes sense.